The IRS just handed Bitcoin miners a huge tax break. And if you're not jumping on this opportunity, you could be leaving significant money on the table. The new One Big Beautiful Bill just restored 100% bonus depreciation for miners. And this change is permanent, removing the phase-down schedule for bonus depreciation first enacted in 2017. By reinvesting in mining operations in 2025, you could elect to write off an entire ASIC fleet in 1 year, opening up the opportunity to reinvest more quickly and improve your cash flows from operations. At TNF, we help Bitcoin miners make smart tax plays and use those savings to scale. So stay with us. By the end of this video, you'll know the key points of the new law, some important tips for applying this new law, and also how to identify some of the unanticipated pitfalls suffered by many mining investors. Welcome to TNF Takes, the go-to spot for crypto companies and on-chain organizations. Before we dive in, make sure you like this video and subscribe to the channel to continue getting top-tier content for your crypto company or on-chain organization from industry experts who have been around the block. I'm Noah Buxton from the network firm, and I'm joined by my partner, Nick Ward. We're here to help you establish trust, build efficient crypto operations, and stay ahead of the curve in an ever-evolving industry. Now, let's talk about why today's episode matters. On July 4th, the One Big Beautiful Bill was signed into law, marking the first permanent tax shift from this new administration that directly impacts Bitcoin miners. Whether you're running a solo rig or managing a large-scale operation, this law gives miners a real opportunity to unlock massive upfront tax savings and reinvest faster than ever. So before you make your next ASIC purchase or plan a Q4 expansion, here's what you need to know. Let's get into it. Nick, thanks for joining me again for another TNF Takes.
Yeah, good morning. It's good to be here.
Good morning. So on July 4th, as I said, the new administration signed into law this One Big Beautiful Bill. That's a mouthful, the OBBB, and created this permanent tax shift specifically related to bonus depreciation. So maybe tell me a little bit where miners were with respect to depreciation expensing and the tax impact of that. Where were we before signing of the OBBB?
Yep. Yeah. So before, miners were stuck with basically a phase down schedule of bonus. So, there was bonus available, but it was limited. It got phased down each year. And ultimately, that's going to come to a close in 2026, where that will be completely phased out. And now, qualified mining gear, so your ASICs, servers, cooling systems, can be fully written off in the year they're placed into service.
Does everything qualify, everything across a mining operation, or just those sort of that category of equipment, fixed assets that you mentioned?
No, it's a good point. Not everything qualifies. And so real estate is still excluded, but generally all the equipment that powers your hash rate, it's going to be game on for that. So I mentioned ASIC servers, cooling systems, power supply units, things like that also may go into it. So that's going to be key. But yeah, real estate still excluded, definitely special rules around that. So if you're setting up shop or you're a miner that has controlled and built, everything from the ground up, you'll want to go a little bit deeper than we'll probably touch on in this podcast. But generally, all that equipment, powering it, everything that goes into getting that hash up and running is going to be fair game.
So it seems like the faster miners can move here at the end of 2025 and in 2026, essentially the faster they can reinvest and potentially capture the opportunity here. So can we walk through sort of how to use this in a little bit more detail to a miner's advantage? I also want to make sure we touch on some of the key mistakes here too, because it sounds great at the outset, but there are definitely some nuances and definitely some potential pitfalls depending on, especially the structure, right? C-Corp versus an LLC or taxes, a partnership essentially. LLC tax default as a partnership. I generally think of this as a little bit of a cheat code for the balance sheet at the outset with, however, downstream impacts and nuances. So take us through what you see as some of the biggest advantages.
Okay. Yeah, we can do that. And again, not to be redundant, but you hit the nail on the head that there are pitfalls. I think we've had people in our pipeline, our network reaching out like, hey, I saw I can write everything off. That's great. Anything I need to know, or can I go ahead and just run it? We're like, well, we should sit down and have a session, or you should sit down with your tax advisor and have a session, because there's certainly other nuances. But to your point, yeah, we could start with kind of some of the strategy, the positives that could be, that cheat code you referenced. So I think one right off the riff is that cash flow advantage, right? So you're purchasing, $250,000 of new ASICs. Yeah, theoretically, you can write off every penny in the current year. You get those up and running, and you've purchased them. And a key point is that you've got them plugged in and hashing, because you do have to place them into service to actually start depreciating. But at $250,000, so 250K in ASICs, that's generally going to be about 75 grand in tax savings, right? Certainly depends on your bracket. But then the question's like, okay, I saved a tax bill, big deal. Well, no, now you can instantly reinvest that. So maybe you can increase your fleet, or I don't know, you have other debt you could pay down, other investments you want to make. So again,
Right.
that's a big deal in terms of keeping that capital available, being able to be used by the business.
Yeah, that's why I think of it as like a cheat code, right? Because on a typical P&L, right, we've got your revenue less your expenses gets you to your taxable net income. Of course, again, a lot of nuance there. But generally, you've got actual cash out of pocket expenses that reduce taxable net income, whereas depreciation is a non-cash expense that passes through in this tax beneficial way. And so just directly lowers taxable net income, but again, without that cash out of pocket. So that's a simple way to think of it, maybe on that sort of P&L or income statement basis. And I think there's a huge planning aspect here too, which we've talked about actually with clients recently, right? So yes, you can create all of these potential tax losses to offset the mining income that you did have in the year, and potentially even carry it forward. There's been a carry back in the past. So like there's much more of a planning aspect here that's needed, right?
100%. Yeah. And you hit two of them, right? Where you have our carry forwards that you can use it and start to set up for that future. So maybe you're towards the end of a cycle, or you've gotten up, but you're plugging in a lot more at year end. So your projections are showing higher revenue coming, higher income, because maybe you've locked in that lower rate. So you've got pretty high confidence in what that'll look like. So yeah, it may make sense to start laying the groundwork for that carry forward to be applied. It also will help lower your estimated taxes, right? Because those are certainly based on a look back to some extent. Hey, what did I owe last year? So the IRS would expect you to make similar payments. And so you could lower that. And again, keeping more cash in your pocket.
Yeah, really important point. I think for miners, a lot of folks that we work with, obviously they come for help, right? Because they need help improving the books and records and improving the tracking and record keeping. But it's very common to see sort of no tax provision or no tax estimate in the financials, right? And so even that just threshold step of getting that into your financial statements or into your tracking, even if it's more simplistic tracking, getting that tax estimate in to begin with is a big help. To then making some of these decisions around what the impact of depreciation expensing would be. I think another thing here on planning is carry back. There used to be under the 2017 Tax Cuts and Jobs Act, and then as amended by the CARES Act, there was a carry back provision which allowed a miner, any business really, but a miner to take some of the losses in a current year and offset actually income in a prior year. That's a really beneficial provision, but it doesn't actually extend in OBBB. So you get the benefit of the 100% opportunity going forward, but not the carryback provision. And also the other big change on the carry forward is this 80% limitation on taxable income on a carry forward basis. So simplistic in year zero, right? You have net operating losses. Those are actually limited on a carry forward basis in sort of year one, year two, et cetera. So that goes to planning in my mind too, right? You need to make the decision. Do you want to hold an NOL, or do you want to deploy capital in a more planned way so that you're really bringing your tax obligation closer to zero, but not all the way into NOL land, and then using more depreciation in the next year?
Those are key points, because again, we talk about, both on here and with clients, that this is a big opportunity to kind of out hash your competition, right? And it's not just because you can, that first bullet point I talked about, you've got cash flow savings so you could reinvest in fleet. It's that if you take this holistic approach to planning and truly map out, not just, okay, I expect to plug in X machines, increase my hash rate, make a gut call on, or an assumption on the difficulty, and say I'm going to have this much revenue. That's great. But if you haven't really thought beyond, your full picture of what are all my expenses? What are the taxes I'm going to have? What NOL carry forward will I have to be able to apply on that income? And to your point, again, it's not just if I've racked up 250K of losses from depreciation, so now I can instantly offset that next year. It's no, you need to plan and know the nuance of it's 80% of income in the next year from that loss. And it goes back to that earlier point of, so maybe we defer some of that capital purchases or even that depreciation in the next year. So again, it's key
Yeah.
to be strategic about this and really try to look beyond just the current year at hand or that current purchase batch.
Yeah, exactly. You don't want to be left with a bunch of sequestered sort of NOLs that can only be used on a go forward basis, sort of at that reduced rate of 80% of income. So,
Yep.
yep, good stuff. All right. So it can definitely be an acceleration lever in the right scenario and definitely depends on the entity type. There's some large distinctions there. So, there's other types of depreciation as well. And I think, Section 179, people might know that number. It's essentially, another tax provision, right? Another type of depreciation that's an incentive for businesses to invest in property, plant, and equipment. And that also had a small change. So there's an interrelation, potential combination of these two, bonus depreciation and Section 179 depreciation. So let's talk through that next. I think that's important for folks to know about.
Yeah, 179, and just in my experience with clients, that's one they're definitely a little more familiar with because, given what bonus was and how it was phased down over the last years, I think that's one they likely took advantage of a bit more, and especially in the bull cycles, right? Because 179, similar to bonus, right? If I put in that example earlier, $250,000 of new equipment, could theoretically under 179 fully depreciate that. Now, why I say theoretically is because 179 can't take you into a net loss. So you can only use 179 up to income. So if my net income was 150 grand that year, and I've put in place 250 grand of basics, I'm only going to be able to 179 to the 150. The rest would have to get, straight lined or another method over a few years. So that's still what 179 is. The Big Beautiful Bill did not change that piece of it. But what it did do is increase the limit to 2.5 million. So it's a higher limit and that you can use 179. And then again, into the planning full picture theme we've been reiterating here is that you can stack with bonus on this. So clients can be strategic about taking 179 to a certain bucket, maybe the ASICs themselves, and then applying bonus to other equipment that supports the hash rate and taking them negative for that net NOL accumulation.
Yeah, great points. I think also I always come back to record keeping, and if you have a tax strategy or tax elections that are this specific, sort of a use of 179, a use of some bonus depreciation, very important to keep the right records around your fixed asset schedule and what assets you're actually earmarking here, right? This isn't just on a total dollar basis. This is specific assets have certain character or classification under the tax code and can be depreciated in certain ways. So it's very important to keep the right records. This can be as simple as a Google sheet, but it needs to be a proper fixed asset schedule so that you can make these elections and also have the backup records to show these elections actually tied to specific assets placed into operation at a specific time.
Yeah, it's a key point. I mean, taking examples like we work with range of clients, right? We've got smaller operations of either sole proprietors or a couple people forming a partnership to much larger scale mining operations. And that comment you just made about good records certainly applies to both because again, you do have to track it for the IRS that you're applying it to what bucket, identify that bucket, and then maintain consistent approach. But going back to 179 versus bonus, it's sometimes the smallers can just focus on 179. They stay lean and efficient, get what they need. And where that stacking I mentioned, that certainly is a larger mining operation that they're going to likely use both those tools for cycles and be looking at that reinvestment piece much more frequently and strategically than say a smaller operation.
Yeah, you mentioned sort of the different client archetypes that we work with, from small to large or partnership to sort of C-Corp. And I think with all things tax, there's, as we've mentioned, these potential pitfalls, right? So there's this potential for lost depreciation or sequestered depreciation. And so let's maybe get into even more specific scenarios here that'll help folks. So yeah, before defaulting, right, to 100%, I think we need to ask some key questions. So we discussed before this, we outlined some key questions. And I think the first one is, if you're talking about depreciation expensing, have you had any profits yet to offset? And so that might be the first key question, right? What are you going to be able to offset? If you're sort of pre-revenue or just getting set up, the idea of 100% bonus depreciation probably puts you in this NOL category. And again, depending on if it's a C-Corp or partnership, the potential to sort of sequester a bunch of NOLs that you can only use at a reduced rate going forward, or even in a partnership, which gets much more complicated, the idea that you have potential lost depreciation. So that's a key question in my mind. What do you think? Let's go through some of these other questions quickly.
Yeah, no, profits is a huge one, right? And again, holistically, what do you look like? Not just, hey, I'm earning this much and I know my utilities X, so I'm probably profitable. It's like, well, have you considered, right, all your other general and administrative expenses, because that all goes into it. So yeah, that's a key one. And then where are you in terms of when did you set those operations up? Because if you implemented that fleet in Q3, for example, and yeah, maybe you are still profitable, what does that next year look like where that fleet's going to get you not just 3 months, but 12 months of revenue? Certainly, what do your costs look like? But right, if there's going to be a higher impact that next year, then let's delay. Right, let's look at that, delay how we're taking it or applying it, and go from there. Other buckets would be, do you frequently resell equipment? This is a big one where, we've had clients over the years that they do take this stance of, hey, they're going to implement the newest, best ASIC they can get in the current year. But whether they've got partners or it's their strategy, they don't wait, that 2 to 3 years to go ahead and upgrade. They're very nimble in terms of, they like to start rotating a percentage of that fleet out year after year. So they're always keeping up with the best, most efficient equipment. And so if that is your strategy, depreciation consideration is a big part of that, because when you do resell, let's say you take 100% in the current year, next year you're reselling a piece of that, the IRS is going to expect you to recapture that depreciation, which just simply means it goes into the equation on the resale as part of your gain, which you'll certainly pay a tax on, separate of what we're talking about here.
Yeah. Yeah, exactly.
Maybe one other one that's always top of mind for me is the equipment financed. This one's, again, kind of a secondary impact consideration, but if you finance your equipment, you certainly have some debt service charges that are part of that. And so when we talk about, this cash flow advantage from it, you're going to want to assess, is that depreciation, that short-term cash flow savings maybe on tax, does it outpace the debt cost? Because if it doesn't, maybe it doesn't make sense here in the current year, right? Or right away, because if you eventually resell that equipment, you'd recapture it. Now you've double hit yourself, where didn't really save that much cash flow because I was paying my interest on the debt. Then I resold the next year and I'm got a higher gain tax payment. So definitely a big piece of the puzzle.
That's a great example, I think, where again, the sort of headline news of 100% bonus depreciation can seem really attractive, but actually a standard maker's sort of schedule or straight line sort of approach when you have debt at play can actually be a smarter approach.
Yeah. I'm curious. I know you've dealt with, I've certainly supported you, but you've dealt with like different entity structures too. Maybe touch on that a bit, because I know that was a good exercise for us.
Yeah, sort of having full cycle insight, sort of full life cycle insight into the effect of depreciation in a C Corp model, sort of a corporate model, versus an LLC or a partnership model, right? So an LLC, as I mentioned, being taxed default as a partnership or as a pass-through entity, meaning the activities of the the partnership entity actually pass through directly to the individual. And so many folks may be knowledgeable about the K1, right? The K1 return is how this pass through items of income, deduction, loss, et cetera, pass through to the individual tax return. And so, yeah, there's a big distinction in planning. A big question you want to ask out front is, how are we structured, and how does this potential for bonus depreciation actually impact the corporate level and the individual level? So, on a C Corp basis, there's the ability to use 100% bonus depreciation, full use in the current tax year, to the extent, again, that it creates net operating loss in that tax year, there is, first off, the carryback provision is removed. So you want to think about that if you have prior years of positive taxable income. And it also limits this carry forward. So there is no concept of capital gain or loss in the C-Corp, right? It's all just income or ordinary income. And so it limits the carry forward basis too, to this 80%, which we've mentioned. Quite a bit different mechanics in the LLC or the partnership pass-through type entity. There are big limitations here and a pretty complex area of the tax code. And so the big three are really passive loss limitations, the at-risk limitations, and the capital account maintenance pitfalls that can happen if an individual partner, for say, is overweighted on depreciation. There can be a reallocation of income to that partner to sort of match the economic effect rules in place. So again, substantial economic effect rules and partnership rules being quite complex. But those are really big distinctions that you want to ask yourself, how are we structured and what's the impact of taking a depreciation election in a current year?
Yep. Yeah, good calls. And I'll add, I know we certainly have a generally more friendly administration to the industry, but the IRS has still stated that, partnerships specifically, and especially complex partnership structures, are very much in their target, for lack of a better word, right, in terms of where they're going to dig in and look for, tax revenue from their perspective, to your
Yeah,
point.
they're
Like,
among the highest risk sort of category
yep.
of filing. Yeah.
And, and hey, that's just meant to say, make sure you, like you just noted, you're looking that up front, you're planning accordingly, you're documenting and considering the scenarios, and you've got, defense for the economic reasoning of what you're doing and how you're allocating things. So,
Yeah. Well, we've talked a lot about planning here, tax planning, but I think the other question is sort of the capital expenditure, capex planning, and look forward in conjunction with the tax planning, right? So bringing these two things together. How do you think about that?
yeah, like I alluded to earlier, like let's say you're towards year end, right, and you've got capital, you're planning to increase that fleet. It's going to be good to take a second and look at that tax planning side, because frankly, you may want to smooth that out. And what I mean by that is, if it's close to year end, and sure, plugging in that hash rate gets you a month of revenue going at that higher amount might be good, but given the full picture, it may make sense to defer putting some of those into service until the next year, right? Because you may have that bonus depreciation to offset more income in the future year, take advantage of the tax benefits. So again, I think definitely mining, certainly, at its core is, hey, increase hash is the name of the game, but doing so strategically is going to be important to ensure the business, operates for many years to come, is prepared for the cycles, should they still be what we've seen typically. Even if they're less violent, there's still going to be some cycles. So you want to be prepared. And I think spreading out that capex planning and putting miners into service strategically is a big piece of that.
Awesome. Yeah, the other one I think about is state tax conformity. And again, we see this sort of in the field, so to speak, where this isn't fully considered. So especially with bonus depreciation, right, we have a change in federal law. You need to ask, does the state play by the same rules? And many do. Many follow sort of federal rules when it comes to this, and others do not. So you want to be knowledgeable about that. I think another common model, right, is maybe you have sort of a holding company level that's a Delaware C-Corp, but you've got mining operations conducted under an LLC entity in different jurisdictions that are, typically good areas for mining, Texas being a very common example. You need to factor in, this isn't bonus depreciation, but it's the other tax impact at the state level, things like franchise tax obligations, which are typically on a gross receipts basis. So they're not on bottom line net income, they're actually on top line revenue is the calculation. So that's another one to factor in, and it goes to this idea of, tax provision or a tax estimate being within your calculations, being within your financials.
Yeah, that's a good point. I think maybe one more for me is, and obviously one of the hotter topics this cycle is the Bitcoin Treasury strategies and companies. And so, miners, frankly, have always been Bitcoin Treasury companies to some extent. Now they are in a much different position where they're earning Bitcoin, but certainly have to liquidate it to keep those operations going. But we've seen many, especially even some of the publicly traded ones, start to build that treasury. And so again, yeah, we've alluded to those cash flow savings going to reinvestment. I certainly include building a Bitcoin treasury as part of that reinvestment. So you can align those benefits, cash savings, with ensuring you're meeting that. So, we've seen clients set up specific targets in terms of how much, what percentage of their profits they want to be able to keep in Bitcoin. And so now you've got another lever to help support that goal, right? And
Yeah. Yeah. The other thing is, I would say the vast majority of miners are actually pretty frequent sellers, right?
oh yeah,
They need to meet debt obligations and OPEX obligations in cash, not in Bitcoin. So they're pretty frequent sellers for the most part. And to the extent that they are having income or loss events when every time they're selling Bitcoin, right? And so this piece of the crypto reconciliation, the crypto activity needs to be tracked as well, because you may actually be accruing in an up market, a significant amount of additional income that maybe not quite factored into your calculations. So that from a planning perspective would make you say, okay, yeah, more loss, more depreciation is a good thing. We've got income we can offset. Sort of in a sideways, a volatile or a down market for Bitcoin, you're actually going to be accruing additional losses, C-Corp, sort of these ordinary losses, and in a partnership model, capital losses. And so that should be factored in with overall tax planning, overall capex spend and planning as well. And just to hit that partnerships point again, because again, most of the miners that are not the big corporates that we all know about are partnerships. And so this, I think, covers the vast majority of mining operations out there. They're really partnership tax. And so they do have this additional complexity. I just mentioned it, sort of ordinary income that's passed through to the individual versus capital gain or loss income or loss that's passed through the partner. These hit different places on the K1. They have different ability to offset, essentially depreciation not being able, ordinary loss not being able to offset capital loss or capital gain, excuse me. There's just limitations there that need to be thought through on the entity level and the pass through to the individual level.
Yep. No, it's a great point because that treasury eventually will be used. So you're definitely going to have that capital gain bucket. And yeah, I think most folks aren't thinking that deeply and planning to identify that, I'm going to have some Bitcoin to sell. So yes, I've covered the cash flow piece in my mind or cash needs, whether it's a down market reinvestment. But did I consider that side of what's the tax on that cap gain? So yeah, that's a good point to reiterate there.
All right. So I think we've given you a bit of an action plan. We've hit some common themes here. And maybe to summarize it, right? We've sort of recommended that you definitely think about your 2025 and 2026 capital expenditures. What's the pipeline that you're placing into operation? Be knowledgeable about Section 179 versus bonus scenarios by entity type. And you want to also keep in mind these BTC Treasury events, sales of Bitcoin. Keep those in mind in conjunction with the depreciation schedules. Potentially restructure if needed to optimize these flows, although that is a bigger effort. And look to lock in sort of year by year tax efficiency as opposed to a simple election of 100% in year one.
Yeah. Hit the nail on the head pretty much. And it's what we love helping with, right? I mean, I think we do a lot of compliance stuff on our side. We help fix a lot of problems that need to be fixed quickly, but it's in the strategy planning that I think, I'm sure you share this sentiment that I have, as I really get excited because now it's okay, we're a strategic partner in helping you really grow this thing that you're passionate about and can come to the table with these points you just laid out that aren't always the funnest thing to think about, but they're key in that long-term plan.
Yeah, great way to end it. So let's put a bow on it. We like to help people be smart in their business, and smart miners model their profits. They model resale of equipment against their fixed asset schedule. They structure and time deductions to have sort of the maximum positive impact on the entity, on the business, and on the individual investor. So thanks for joining us for another TNF Takes. Again, like the video, subscribe to the channel to continue getting top tier content from industry experts who have been around the block. Thanks.
Thanks, guys.